YouTube, hello and welcome back. Thank you so much for joining me on another video. I know it's been a little while. I've been busy doing some one-to-one coaching with you lovely people that have come through here on YouTube and have come through Instagram. So that's been taking up my time and it's been incredibly rewarding, incredibly great to see people really have that light bulb eureka moment. Today, we're going to go through some major psychological barriers that a lot of traders have. It's a very common struggle amongst traders on their come up in their journey. We're going to go through how you can combat these, how you can work on working on them and suppressing them and getting so much better from a psychological mindset aspect. Let's get stuck into it. So first thing would be people's sheer inability to stick to their trading plan. They waver from it. They try and then change certain habits of it, but not in a positive way. Let me explain. So first things first is you should be having, and this is just to help this, you should be having a strict list, not in here, it will be in there, but it should be written down, okay? That's where I want it, written by your monitors, written by your laptop, frame it, whatever you want to do. It's in your notebook, it's in your journal, it's by your bed, it's on your phone wallpaper. I don't mind what you do, but it's a strict list of your set criteria of how you formulate your trade, you formulate your area of interest, how you formulate your fundamentals, how you bring it all together, that holistic approach, all the nitty-gritty nuances of what gets you to that point just before you pull that trigger on a trade. Write it down, because I know as traders coming up, I've been there myself, you will have these feelings, as I'm talking about, you'll have these feelings where you think, oh, that doesn't look too bad. I might just take that, because you've just had a couple of losses. I might just take that setup. And actually, if you were to look at your rules, it would fall outside of those rules, hence not being an optimal setup. Go through that checklist in chronological order of how you formulate your trade. If it gets the green light at the end and there's nothing that falls outside of it and all the criteria is met, you take the trade. If it's not, you sit on your hands until that checklist is met. And if it never gets met, you sit on your hands, you wait, you let that potential setup go. There is always another setup. You have to get good at being at peace with that. There's always more setups. And you will just regret taking that trade or forcing that trade when it didn't meet your physical criteria. So try it, write it down. It will sometimes just be that thing that stops you from breaking your rules, because you can see it physically there and it's just enough of a psychological reminder. The next thing I want to talk about is people's fear or hesitation of entering a trade, okay? This can come after winning streaks. This can also come after losing streaks. Fear and hesitation when it comes to decision making is an emotive type of decision making. It's the type of decision making as traders we do not ever want to be making. We want to be making systemized decisions, okay? Decisions based on how much we're risking, how much the risk to reward is, does it meet our optimal criteria, are all those conditions there that I talked about in point one, that optimal criteria, are they all met before we execute the trade? Okay, so that's what you need to be thinking about before a trade. And this is why it ties into point number one quite nicely. If you've got that systemized rule set in front of you, written out, clear and visual to see, sometimes that's just enough at suppressing that hesitation, suppressing that fear whilst you're still growing and learning as a trader. Okay, another thing to this is I'm 11 years in. I am a trader, of course, but I call myself more of a fantastic risk manager compared to trader. I'm a very disciplined risk manager. That's what I'd call it. What I mean by this is you should always be thinking in probability. So again, it gets you away from that emotive decision making. For me, I'm always risking the same amount on an initial position. It's always 1%, okay? It's always has been, okay? I take a minimum risk reward of 1 to 3. Now, that doesn't mean 1 to 10s, 1 to 8s. That's nonsense. That doesn't happen. But a 1 to 3, a 1 to 3.2, 1 to 3.5, 1 to 4, something between 3 and 4%. If your strategy, just on a caveat here, if your strategy doesn't allow you to even get 2%, 3% trades, then you have a strategy issue, okay? Or you're missing some major things, or you're out of sync, okay? And you're not prioritizing the higher time frames. Anyway, so if you're taking a minimum risk reward of 1 to 3, it's very good, again, suppressing the emotive side, because let's say you're 2 or 3 losses on the bounce, you're 3% down for the week or the month. You know in the back of your head, as long as it's an optimal setup, your edge doesn't play out over weeks. Your edge plays out over quarters, months, years. That's what longevity and true success looks like. So you keep taking your optimal setups with the same percentage amount risk, with the same minimum risk to reward, because then all you need is that one win that takes you back past break even for that week or that month and into the green. Okay. So you've seen this argument before with risk to reward versus win rate. Win rate, please don't focus on, because you cannot control it. I don't care what people say. I've been around a very long time. You cannot control your win rate, but you can control your minimum risk to reward. And we all go through losing periods because, the markets are the markets. Yes, they're cyclical, but there can be a lot of randomness at times. So you are going to have times where you take 3, 4, 5 losses on the bounce. But with the way my edge and my strategy works, I'm only one winning trade or 2 winning trades from being back in the green. And it's the spillover effect that positively has on somebody's mindset, knowing, well, if I stick to my plan and continue executing my edge and how I should, my set of rules, everything we've already talked about, then you will override those natural 2-3 losses that you're going to get fairly frequently. You'll override those, and you'll still finish the month in green. You'll still finish the quarter in green. And there's something very reassuring and at peace with a trader's psychological mindset, knowing that if you're going down a risk to reward of a 1-to-1, if you're 5 losses down, you need 5 wins just to get to break even. That puts a much more emotional strain on a trader. So please don't go down that route. Okay, systemized thinking and decision making, not emotional. And last but certainly not least is FOMO/over trading. They come hand in hand. Okay, if you FOMO, you end up over trading. Now, it's all tied in quite nicely, and I've done this for a reason, so you can focus down on just a few things that will then have a massive positive spillover on the rest of your psychological mindset and strategy, if you like. FOMO. First thing I would say is, look, I miss setups, you'll miss setups, we all miss setups that we've been scoping out. It might be because you're busy doing something, you're driving, could be anything. It doesn't matter. What I say to traders is, flip this on its head. Let's say you've had an area of interest. It's been met to a T. The market's agreed with you, right? But it's left without you. Don't be frustrated. Think of it like this. Change your mental rewiring and framework with this. Just think, actually, okay, the market's agreed with me. That is the biggest confluence there is. It's the ultimate final confluence at the end of that checklist we were talking about in point number 1. That's awesome. The market says, yep, we agree with you, Philip. And the market's hopefully going to continue in the direction you were planning and analyzing for and you've anticipated. Then it's a simple case of, this is why I trade higher timeframes. Then it's a simple case of just dropping down to the lower timeframes, maybe the 30-minute, and seeing, some of you might hear 30-minute, think that's not a lower time frame. It is a lower time frame. I'm a higher time frame trader, as you know. But you drop down to the 30-minute. You don't jump in straight away. Let's say we're bearish. You wait for that next swinging lower high to be formed, where you get that better risk to reward, that better entry, and you simply scale it on a lower time frame as a continuation trade. And the perks of doing that is, as I said, the market's already confirmed from a higher time frame perspective that it agrees with you. You're right. Okay, and then you can scale in, and then arguably you can get a better, tighter stop loss, a better risk to reward, whilst managing to catch less pips or managing to spend less time in the market. Again, so mitigating risk to a degree. So it's a win-win. So reframe your mind that way compared to thinking, oh my goodness, I've missed it again, and then you get in at crap entry price, the risk to reward skewed. No, again, systemized thinking, be patient, level-headed emotional control, and think, right, market's agreed with me. I'll now scale in if the opportunity presents. Guys, I hope that's really helped. If you do want some one-to-one coaching from someone genuine, someone who's been there, someone who's been in the trenches, I'm 11 years in now, drop me a DM or check the link out below. I will take you to where you want to get to. I can guarantee you that, and we will get you the results you want. Other than that, guys, thank you so much for watching. It's a pleasure, and I love filming these and just pressing record and getting on and speaking. Yeah, just speaking. So, as always, guys, I'll catch you on the next one, and thank you so much if you stayed to the end and watched it all the way. Cheers, guys.